For the past couple of years, it feels like big tech has been the only game in town when it comes to the stock market. But a new fall forecast from Barron's suggests that could all be about to change. So the big question is, are we on the verge of a major leadership shift? Let's break it down.
On the surface, this bull market looks absolutely unstoppable. The S&P 500 is up a solid 10% this year alone. It just seems to be shrugging off any and all bad news.
But here's the catch, and this is really the whole point of this explainer. That big, impressive number doesn't tell the whole story, not even close. In fact, if you weren't invested in just a tiny handful of specific companies, you might have missed the party completely.
And the imbalance is just staggering. Look at this. Almost all of that 10% gain has come from just 7 companies, the ones we now call the Magnificent Seven. So while names like Apple and Nvidia were soaring, the other 493 stocks in the index, they barely moved the needle.
So, this brings us to the first part of our story, a market that has become dangerously top-heavy, with all of its fortunes seemingly tied to just a few tech giants.
And this performance gap, it goes way deeper than just stock prices. It's all about earnings. Analysts are expecting the Magnificent Seven's profits to grow by a whopping 24% this year. The rest of the S&P 500, less than 7%. It is truly a tale of two different markets living inside the same index.
But this raises a pretty critical question, right? Can this kind of narrow, top-heavy market really last forever? Well, the Barron's analysis suggests that we're starting to see some pretty serious cracks in that foundation.
The big issue here is valuation. A simple way to measure this is the price to earnings, or PE ratio. And right now, the Magnificent Seven stocks are trading at over 30 times their forecast earnings. But look at the contrast. An equal-weighted version of the S&P 500, where every company counts the same, trades at a PE of less than 19. That is a huge premium to pay just for popularity.
And of course, that high price creates a lot of risk. As portfolio manager L. Joshua Wine puts it so well in the article, with valuations this high, there's just very little room for error. One bad earnings report or a tiny slip-up in strategy could send these stocks tumbling.
So, okay, if the Magnificent Seven look a little risky, where's the opportunity? Well, the core forecast from Barron's is that the rally is finally about to broaden out and give the rest of the market its moment in the sun.
According to the analysts they talked to, there are two major forces that could kick this off. First, you've got the prospect of more fiscal stimulus from Washington, designed to help out the parts of the economy that have been lagging behind. And second, you have the Federal Reserve strongly hinting that they're getting ready to cut interest rates, which makes money cheaper for everyone and really encourages investment across the board.
And when you combine those two things, it's powerful. As one strategist from Morgan Stanley puts it, that's a pretty bullish cocktail for markets. It's basically a recipe that could lift all the boats in the harbor, not just the 7 biggest yachts.
So how does this all translate into actual opportunities for you? If this rally really does broaden, a whole new set of stocks could take the lead. The article promised what to buy now, so let's dig into what they're suggesting.
The valuation gap between different sectors right now is just huge. You've got information technology way up here, looking really expensive. But then you have sectors like healthcare and financials that are trading at nearly half that valuation. That suggests they have a whole lot more room to run if the market's focus starts to shift.
So, to kind of sum up the domestic ideas, the article is pointing investors toward these areas that have been overlooked. Financials and industrials often do really well when interest rates get cut. Small caps, smaller companies, have been pretty beaten down and could be ready for a comeback. And healthcare, well, it just offers some compelling value after being largely ignored during this whole AI frenzy.
And here are just a couple of real-world examples from the article of what these companies actually look like. You've got Becton Dickinson, a medical tech company, trading at a PE of just 13.5, or the regional bank UMB Financial at less than 13 times earnings. These are established, profitable businesses basically hiding in plain sight while all eyes have been on big tech.
But hey, the opportunities don't just stop at the U.S. border. The article also highlights an alternative strategy for investors who are looking to diversify away from this top-heavy American market.
Okay, now this part is fascinating. While everyone has been obsessed with the U.S., a major international stock index is not only significantly cheaper, with a PE of just 16, but it has actually outperformed the S&P 500 so far this year. So clearly there are strong returns being found elsewhere.
And here's the really cool part. You can still get exposure to these massive trends like AI without paying a crazy premium. For example, the article points to Samsung Electronics. It's a huge player in the semiconductor industry, but its stock trades at just 16 times earnings. That's a massive discount compared to a company like NVIDIA. So that brings us to our final big question. We've seen this historic concentration of performance in just a handful of stocks. But with valuations for the leaders looking stretched and this bullish cocktail of stimulus and rate cuts on the horizon for everyone else, well, the stage could be set for a really dramatic shift. So, were the Magnificent Seven the story of the last 2 years? And is the rest of the market the story of next year? That's the big idea to take away from this explainer.